Good morning, everyone. Welcome to class. Good morning, welcome to class. Good morning, how are you doing today? Happy weekend, if I must add. So I'll just wait for a few minutes for others to join the class before I begin. All right. So I believe we can begin now. Others will be joining us as we start or as we continue rather. All right, so we are continuing. This is the final class on final account of a sole trader. All right, and don't forget, we have actually dealt with the original talk about final account, and we are um, currently dealing with the adjustments that happen to financial statement. Don't forget, we said there are certain adjustments that we have to that we have to do what for financial statement. Do we understand that? So to make your financial statement correct and accurate, there are certain adjustments. It means that there are certain transactions that happen during the week, during the period, during the year that have to be adjusted before they are treated in the financial statement. So in our previous lecture, we talked about depreciation of fixed assets. And in today's lecture, we'll now be entering into accruals and prepayment, bad debt, and provision for doubtful debt. Now, as we continue, I'm going to I'm going to display I'm going to display the Padlet link because over the weekend we'll be having a lot of interactions there. All right, so that's the Padlet link. Is the one rolling below your screen. All right, so it's the one rolling behind below your screen. So during the week, over the weekend, you are going to have a number of interactions there, and yeah, I want it to be like that. So now let's continue. So let's move on to the topic for today, final account of a sole trader. But I said we are talking about adjustment. We have talked about depreciation in our previous class. So now we'll be talking about bad debt. Bad debt. Bad debt. Now, what are bad debt? What are bad debt? Bad debt, another name for bad debt is irrecoverable debt. So whenever you see bad debt, this is what should come to your mind. Irrecoverable debt. Do we understand that? So it basically means that bad debts are your debtor. What does that mean? So we are sorry, that a particular debtor can no longer pay. So for example, if I sold goods, sorry, All right. Sorry for that break. So you can happen. I said bad debt happens when you can no longer retrieve or recover a particular debt from a particular debtor. So you sold goods of 500,000 naira to Mr. A, just as you can see on the screen. All right. But Mr. A paid 300,000. Then after that 300,000, you notice that something Mr. A went bankrupt. And when somebody goes bankrupt, it means that the liability of that person is greater than the asset. And what's the effect of that? It means that the person does not have the capacity to pay back his debt. So the law can rule out the person as what as bankrupt. And once they rule the person as bankrupt, it means you cannot go and claim any money. Do you understand that? Or you might just be able to claim part. So what happens is that you have to write off that bad debt as what? As expense. So when an entity discovers that the debt can no longer be recovered, the debt is written off as bad debt. What is that trying to say? Don't forget that when that item was still a debt, it was an asset to you, to the firm, the company. Why is that? Don't forget, we said asset is anything that makes you to be expecting benefit in the future. Because this person has bought goods from you, you have an expectation that this person is supposed to give you 200,000 naira more. All right, 200,000. Now, once there is no longer any expectation, then that money has become a loss. Do you understand that? And a loss, whenever you have a loss, is treated as what? As an expense. So what you have to do is you have to remove it from the asset to show that it's no longer an asset. Then you now take it to an expense account. So this is now the explanation. The double entry is you have to debit your bad debt account and credit your debtors account. What does that mean? So let's prepare Mr. A's account. So let's assume that Mr. A's account was like this. When we sold goods of 500,000 naira to him, we will say debit Mr. A's account and credit sales. So we say sales 500,000. So do we understand that? We say sales 500,000 naira. Abi? Now that when he paid this 300,000, we would say cash or bank, as the case may be. You say debit cash because you are receiving money, and credit Mr. A's account is the giver. That will be 300,000. Now there is a balance of 200,000 naira here that he has not paid. This guy has not paid 200,000 naira. Is that fine? He has not paid 200,000 naira. So if you look at it, so now once this thing becomes bad debt, it means we can no longer what? We can no longer retrieve that amount again. So what do? We have to what? Write off, which means that instead of you receiving this money in cash, you are saying that this money can no longer be received. So you have to close up this account finally, because normally we are going to have a balance brought forward of 200,000 yen. All right, but if you remain this 200,000 yen, it means that you are still expecting money from him. All right, but what you now do is that this 200,000, since we are no longer expecting it, let's just write it off. So you come here, you say bad debt. So you have seen that you have credited debtors account, that's Mr. A's account, with 200,000. Then you come, so by the time you do that, you notice that there is no balance on this account again. So no expectation from him. Then you now open an expense account called the bad debt account. All right. So that will now be, if you are crediting Mr. A's account, then you have to debit bad debt, abi double entry. So you come here, you say Mr. A, you say debtor, let's say debtor, Mr. A, naira sign here, 200,000. Now this 200,000 will now be closed. This account will now be closed to the profit or loss account. as an expense. So don't forget, if it is on the credit side, then it will now go back to the debit side of your profit or loss account as an expense. Do you understand that? So that's why bad debt is an expense. An expense is something that you have enjoyed the benefit and you no longer expect anything from it. Do you understand that? But so when it comes to the point where an a customer can no longer pay up his debt, then you have to what? You have to write it off as expense. Do you understand that? To show that we are no longer receiving anything from this particular person. So that's basically the way bad debt works. This is everything about bad debt. So any debt that can no longer be recovered from the debtor is known as what? Bad debt, and is also known as irrecoverable debt. Reasons include death, sickness, insanity, or bankruptcy of the debtor. Don't worry, I still so this is it. You can have a typical question like this, but pay attention. This is the accounting entry. You have to debit your bad debt account and credit your debtors or trade receivables account. Don't forget, I told you guys that your debtor is now also called trade receivable. We are still talking about the same thing. Do you understand that those are the people that owe you money through the sale of goods? Do you understand that? All right. So is that well understood? So that's that about bad debt. So don't forget, bad debt is treated as an expense. These are the things that you have to pay attention to. It's treated as an expense, and because of this, you notice that we always deduct bad debt from our what? From our financial statements or from our debtors. So they can give you a question where they will give you the amount of debtor and then they will now tell you that there is a bad debt of so so amount. You have to remove the amount of bad debts from the balance of debtors. Do you understand that? So that's the way it works. Now let's move to provision for doubtful debt accounts. Provision for doubtful debt account. Now provisions are liabilities of uncertain timing and amount. What does that mean? Don't forget, we say liabilities are they arise from past events, all right, and they result in an outflow of economic benefits. So it's like the opposite of asset. For asset, you are enjoying economic benefit. For liabilities, there is an outflow of what? Of economic benefit in the future, or there will be an outflow of economic benefit in the future because of the presence of that liability. Now, but provision, the way provision work, provision is not exactly liability. It's a kind of liability that you are not sure it will happen. You just have there is a probability that it will happen, but you cannot be sure when it will happen, and you cannot be sure the amount that will be involved. So what you do is that you estimate it. All right. Provisions are estimated. That's why when you are doing provision for doubtful debt, you see them telling you, giving you maybe a percentage. They will say provision for doubtful debt is 10% of debtors. All right. It is because it's not something that has happened. We are doing this because of the prudency or conservatism is the same thing. Convention. Alright, this is why that's why we are actually doing this. Do we understand that? So conservatism or prudence concept is telling you that don't anticipate revenue, don't overstate your revenue, alright, but you should provide for every possible losses. Make provision for every possible losses, that if there is a probability or a possibility that something can happen, that you might lose money in the future, provide for it, make a provision for it, which means charge it against profit. So provision for doubtful debt are charged against profit as a result of probable default by the debtors of the firm. So for bad debt, you notice that bad debt is called bad or irrecoverable, but provision is not made on bad debt. That's why it would be wrong for you to say there is something like provision for bad debt. All right, it has happened already, so it is not of uncertain timing. It is something that has happened. You just have to write it off. But provisions are made for doubtful debt. All right, when you are beginning to contemplate that maybe somebody will pay or the person will not pay. Do you understand that? So why do we have provision? It is because in every business there is what? There is an element of risk. There is what? There is an element of risk. What does that mean? It means that if I sell goods to people on credit, I must be able to, it is because I am embracing there's something called credit risk or default risk and default risk. So what's this saying? It's saying that if you sell goods to somebody on credit, there is a probability that they will not pay back. If they don't, all right, there is a what? There is a probability that they will not pay back. And it makes sense, as simple as that. And that's why we make provision. So we are saying that, so they make, for provisions, we make estimates based on our interactions with all of our customers, the type of customers that we have, and all of that, the credit worthiness, right? How reliable the customers are. So we can say, out of all of this debt, if we have 1 million naira debt, we might not be able to recover 2.5% or 10%. Do you understand that? So it's just an estimate that we are making. So we have to now charge it against profit. So loosely, it is like setting money aside out of the profit. But don't forget, you are not actually taking actual cash, all right? But you don't want to overstate your profit, because if that liability materializes, if that your estimate, if it materializes, then your expense will be low. So you are just saying we don't know if it will materialize, but let us provide for it by removing it from our expense just in case it happens over the year. So provisions can increase and they can also decrease. Now, accounting entries for provision. Now, the same way we have provision for doubtful debt, we also have provision for discounts. And for provision for discount, let me write it in a separate thing. So we also have provision for discount allowed. And what does that mean? We are saying that, you know how discount allowed works now. Cash discount is given for prompt payment. So we will tell you, you owe us so amount. If you pay this amount within 30 days, then there will be a 10% discount. Now, if that happens, there is a possibility or a probability that that person will meet up with that deadline and they will pay before it. And if they pay before it, we would have to give them 10% discount. So we have to make provisions for that just in case they meet up with it. Do you understand that? So that's provision for discount, and they actually work the same way with what? With provision for doubtful debt. I mean, the accounting treatment is the same thing. There's just something that I'm going to show. I'll go to the workbook now and write out something. So please pay attention to that. Those are the, I will show you a kind of way that they can ask you a question regarding provision for doubtful debt and bad debt and all of that. I'll give an illustration for it in the whiteboard now. But let me just explain this. Let me explain the accounting entries. All right. So now accounting entries for provision and doubtful debt. When you have a new provision, that is, they are just making a provision. How will you know that? Maybe you see something. This one is for maybe theory. If you see something in the additional information, and then you see provision is to be made of 10%. You see this in the additional information, but you are not seeing anything in the trial balance. It means that they have never made any provision before. So when a new provision is made, you have to debit your profit or loss account. So this is what you must know. Increase in provisions lead to expense. Decrease in provision leads to income. What does that mean? Let's look at it. Provision for doubtful debt are charged against profit. So if something is charged against profit, it means that it is what? It is an expense. So if it is increased, it means that you are charging more. So that means expense is increasing. Do you understand that? And decrease in provision means you are charging less. So that's like an income. So if I was charging 10,000 before and now I'm charging 5,000, my the liability has reduced. The provision has reduced, so that's an income. So when you make a new provision, it's like you are moving from zero. So let's say you make a provision of 5,000 naira. It's like you are moving from zero to 5,000 naira. You have to charge this whole amount to what? To against your profit. You have to charge it against profit. So if you want to charge it against profit, it will be on the debit side as an expense. So you say debit profit or loss account and credit provision for doubtful debt account. Do we understand that? Debit profit or loss account and credit provision for doubtful debt account. With what? With the total amount of provision newly made. That's the 5,000 naira. Now, what if it happens that after the first year we had this 5,000 naira? They now said that in year two we want to increase the provision to 6,000 naira. So please, you have to pay attention to English here and to details. Sometimes they will tell you that provision was increased by 1,000 naira. If they give you this, then you know that the actual increase of provision is what? Is 1,000 naira. It increased by. But they can say it increased to. If something increased to 6,000, the amount of provision that you are using in your profit or loss is not 6,000. You go and look for the old figure. If the old figure is 5,000, you now say this 5,000 increased to 6,000. Then you now say, oh, it means that it must have increased by 1,000 naira. So your increase, the amount of increase is what? 1,000 naira. Do you understand that? So increase in provision is still the same thing as this one because it's still increasing. You debit profit or loss account with the amount of increase and then you credit provision for doubtful debt account. I'm going to show an illustration now. Now, the next one is decrease in provision. If provision decreases, what do you have to do? You have to debit provision for doubtful debt account. So it decreases, it means it can decrease by or decrease to. So it means that the 6,000 is now coming back to 4,000 naira. So that's an income. So you debit provision for doubtful debt account and you credit your POL account. Why are you doing this? Don't forget, you have put 5,000 naira on the debit side before. Now that it has reduced, you are bring if it increase, you added another 1,000 naira, making 6,000 naira total that you have charged as expense. They now say it reduced to 4,000 naira. You have to make your total expense as provision to reduce to 4,000 naira. So if you want to remove this, if you want to reduce 6,000 to 4,000 naira, what do? You credit it with 2,000 naira. So you credit your profit or loss account with the amount of decrease. Now let's take a little bit of illustration. I'll just sketch it on the whiteboard here. Now let's say 1/1/2025. So 31/12/2025. I'm using the same example that I used. So you have something like this. So this is the way it's going to work. You are going to have a P. Don't forget, whenever we are doing stuff like this, your P or L is like an extract. So you come here, you say P or L extract. So you just draw up an extract of your profit or loss account, and then you come here, you say provision for sorry, provision for doubtful debt account. So we are starting with the year 2025. In year 2025, provision was newly made of 5,000 naira. What's double entry? Debit P or L account, because we are just making provision with 5,000 naira, and you have to credit this one with 5,000 naira. So you say this is going to where? P or L, and this came for provision for doubtful debt. I just shortened it to this provision for doubtful debt because of space. So don't worry, you know this is an extra, so you just close this. Then you have to balance this. This is like a liability account. So then it's going to have balance brought forward 5,000 naira. All right. Now in year 2026, now if they now said provision was increased to 6,000 naira. What this means is that at the end of 2026, we must have total provision of 6,000 naira. It increased to 6,000 naira. Do you understand that? At the end of this year, at the end of the period, provision must what? At the end, provision must be 6,000 naira. So it means that, don't forget, you have balance carried down of 5,000 naira a year. Now, if you want this provision to be 6,000 naira at the end of the year, what do you have to do? It means that you must add 1,000 naira to it. So you can come, so that 1,000 naira is now the one going to what? P or L. That's the amount of increase. So 6,000 minus 5,000 is 1,000. So then you come here, 2026, provision for doubtful debt, 1,000. Then this is 6,000 and 6,000. Then you come here, say balance carried down again, just like this. Sorry, this is balance carried down, 6,000. Then in year 2027, your balance brought down is now what? 6,000. Do you understand that? Now they now said this provision for doubtful debt must be decreased to 4,000 naira. So what do you do? He's saying that your at the end of the year, your provision must now be equal, which means your balance carried down in this account must now be equal to 4,000 naira. So what do? You come here for 6,000 to turn to 4,000 naira, means that you must remove 2,000 naira from it. So you come here, you say P or L, because you want to remove 6,000 from here, you have to put it on the other side. Sorry, you want to remove 2,000 from this, you have to put it on the other side. So you come here, you say P or L, 2,000. That now means that in the year 2027, nothing is coming here. Debit here, it has to have a corresponding credit entry here, abi. So you come here, you say provision for doubtful debt, 2,000. So at the end of the day, when we do this here, we have total of 6,000. All right. We will now have a balance carry down of 4,000. Can you see it decreased to 4,000 naira? If you want to write this, you can say it it increased by 1,000 naira here and it decreased by 2,000 naira. If they give you something like this, just know that once they put by, you are using the figure as the one going to POL directly, just as we used it here. Do you understand that? So that's it for provision for doubtful debt. And this is the same way you do for provision for discount allowed. Now let me show you another thing. It is possible they ask you a question like this, saying that, so they can give you something like this: total debtors balance was 20, let's say 80,000 naira. Then they discovered that there was bad debt of 10,000 naira. Then they also want to do provision for doubtful debt of 5%. Let me not make it hard. 10%. Then provision for discounts of 5%. So they can now ask you this question, that how much will be provision for discounts allowed, or how much will be the provision for doubtful debt. Now this thing might look simple, but it is not that simple, which is not that direct. If you want to calculate provision for discount in this case, you cannot do 5% of 80,000 naira. It will not be correct. If you want to calculate provision for doubtful debt, you cannot do 10% of 80,000 naira. It will not be correct. So what do? You have to redraft the debtors. If we have debtor of 80,000 naira, don't forget we now have bad debt of 10,000 naira, which means our debtor of 80,000 naira is not actually what. And don't forget, they can tell you that this 10% is 10% of debtor balance. But don't forget, this debtor balance is not correct because we have bad debt. You have to remove the bad debt first before you now attach the what? The debtor, the 10% of doubtful debt. So this is the way you do it. You say debtors 80,000 less bad debt 10,000, that's 70,000. So this 70,000 is now your correct debtor balance, because you cannot add amount that you know that you can no longer receive. You cannot put it as part of your asset. It is not an asset. You are not expecting money from them. So you have to remove the bad debt. Except both bad debt and, if you are doing a theory question and both bad debt and debtors balance is given in the trial balance, then you don't have to deduct it anymore. It means they have deducted it already. But if your bad debt is additional bad debt or in additional information, then you have to deduct it from the debtor balance. So that's for theory. But if they list it for you like this in your exam, then you know that you have to do this. So this now less provision for doubtful debt. Your provision for doubtful debt will now be 10% times 70,000, because doubtful debt is saying that you don't really know whether they will pay, but you already have the one that you are sure that they will not pay. So remove that one. Don't calculate estimates on money that you cannot collect again. Do you understand that? So your doubtful debt is a percentage of the amount that you are still hoping to collect. Bad debt, you have written it off already. So 10% of 70,000, that gives us 7,000. And by the time you remove 70,000, 7,000 from 7,000, you have 63,000. Do you understand that? So you now say less provision for discount. Now don't forget this doubtful debt is saying that we are not sure whether these people will pay up, but discount is saying that it is possible for them to pay on time. So can you see that it's like against each other? One is saying that we are not sure these people will pay. One is saying that we don't know where if they will pay on time, but they can pay on time. So if they pay on time, then we would have to give them a discount. Don't forget, if you think that somebody will not pay on time, are you going to give them discount? No. Why? Because before you even think that somebody is not going to, okay, let's assume that you bought something from somebody and you and the person agreed that you pay within 7 days. The person now called you on the second day that, how far, where's my money now? Is it that you don't want to pay me again? You'll be like, what's going on? We agreed 7 days. You are calling me on the second day that is it that I don't want to pay again? It does not make sense now. The only way it will make sense is that after that 7 days and you have not paid, the person can now call you and be like, what's going on? You have not paid. That's when the person is now having what? Is now being skeptic about whether you are going to make that payment or not. So that's provision for doubtful debt. So we have removed the people that are doubtful. This is the 3,000 and the people that are still sure that they will pay. So these are the people that are eligible for discount. If we are uncertain about your payment, it means that you have actually gone beyond the time that we gave you. Do you understand that? So there is nothing like discount for you. So if you want to charge your discount will now be 5% multiplied by not 80,000, not 70,000, but this 60 doubtful debt and provision for discount allowed. That's what I wanted to show you guys. So you can see how that works. So please pay attention to it. Oh, this thing is actually what's very, very important. Because this is the kind of questions that they want to ask you. Because this is the actual question that tests if you actually understand um, provision for doubtful debt. All right. In a few minutes, I will display the attendance code so that you can mark your attendance. Now let's continue. If you have any question, drop it in the comments and then we'll. So let's move on to accruals and prepayment. Accruals and prepayment. Now, what is the essence of accruals and prepayment? How did we get there? How did we even think of something called accruals and prepayment? Now, this is because of the accounting concept, which is accrual concept. But before I even go there, this is the way it actually came up. Don't forget, people don't always pay when they buy goods. And even we don't always pay when we do what? When we buy something. What does that mean? It means that when we trade, when we buy something, there are two movements. Don't forget, trade is a from commerce, you know that trade is a voluntary exchange of goods and services. All right, trade is a voluntary exchange of goods and services. So when there is an exchange, there is two movements, the seller and the buyer. There's two movements. There are two parties rather, then there's two movements. The seller gives So something moves from the seller to the buyer, but the buyer too must also give. Do you understand that? So when it comes to trade, one thing that moves is goods. We move this way. If goods or services move to the right, then something else must move to the left. And that's what? And that's money. Now, in a case where these two movements, when they happen together, that's when we say we have a cash transaction. So I come to you and I'm telling you, I want to buy bread. I give you the money, you give me the bread immediately on the spot. That's a cash transaction. But there is a possibility of money moving before good, then or goods or services moving before money. Do we understand that? So your money can move before your goods or services, or your goods and services can move before your money. Do we understand that? All right. So now when that happens, when this happens, when money moves before goods, that's when we say we have something called prepayment. It means that a payment has been made before there is a movement of goods. Do we understand that? That's prepayment. That is, payment happened before goods was supplied, before services was rendered. Now, when we have goods or services moving before money, maybe they sent goods or they offered services today, you now pay next year or next month, then that's when we have accruals. Stay with me, guys. So for these two, it can now be prepaid expense or prepaid income. Now, please pay attention to this. All of these things just perspective. Now, this one, you can also have accrued expense and accrued income. Now, if you want to explain this, since you know that accruals, ACCRUALS, don't mind my handwriting or the way I wrote it. Now, if you now know that accruals means that your service is moving before money, that means you have service has moved before money moved. If you now come to expense, from your perspective, it means that you have incurred an expense. All right, you have incurred an expense, which means services has moved to you. If you incur an expense, it means you have enjoyed a particular service, but you have not paid for it. That's a credit you are owing. Do you understand that? So because services have moved and then you have not paid, so money will go out of your account later when you later pay. That's liability, because you expect that future economic benefit will flow out. There will be an outflow of money. You are owing somebody. So when you are owing somebody, that's what? A liability. So we say this is current liability. So you can say accrued expenses occur when an organization has enjoyed service but they have not paid for it. It's as simple as that. So for example, we use electricity, but we will not pay for it next year. And as at this year, we said we'll pay for it next year. As at this year, it is a liability to us because we are using something that we are not paying, that we have not paid for. So accrued income, look at it from your perspective now. What will accrued income mean? Don't forget, goods or services are still moving before money. But now, instead of you enjoying the service, which makes it an expense to you, you are the one rendering the service. What does that mean? Somebody approaches you as an hairdresser and he says, I want to make my hair. Can you kindly help me make my hair? I will come back and pay you next month. Once you make the hair, you plait the hair, you do all of those things, you have rendered the service and you have earned your money. When we say earn your money, means that you have the right to collect your money already. But the customer said he does not have money to pay yet. He will pay next year or next week or next month. To you, it means that that customer is owing you. So when somebody is owing you, is that an asset or a liability? That is an asset. So accrued income is a current asset. Do you understand that? So accrued expense is current liability because you are owing somebody. You have enjoyed the service that you have not paid for. Accrued income is current asset because somebody is owing you. You have rendered a service that you have not received money for. So now let's go back to prepayment from the two perspectives too. Prepaid expense, it means that money has moved before goods or services moved. What does that mean? Payment has happened, but there is no rendering of services. There is no enjoyment of services. Now let's start from expense. Prepaid expense means that you have enjoyed. Expense is about enjoying a service. But if it is prepaid, it means that I have not enjoyed this service. I am supposed to enjoy this service, but I have not. But even though I have not enjoyed this service, I have what? I have made payment. Money has moved before the services. Do we understand that? Money has what? Money has moved before the services. So what happens then? It means that let's assume, let's do it this way. We want to use electricity next year. And this year, we just thought that let's pay this electricity bill for this year and next year so that we just focus on other things. Let us not be thinking about something like that again. Once you pay electricity bill for next year, don't worry, you have not even gotten to next year. The way you use it, you have not used it. It means that it's like you are giving them money. So they are actually what? They are owing you. They are owing you service. They are owing you money. Your money is with them and you have not collected anything from them. So it's if I go outside and I say I want to buy bread, but I now give them 5,000. I say I'll come and pack my bread next week. At that point in time, there is what? There is a liability on them to what? To give me my bread. So prepaid expense to me, because I am the one that have made payment, but they have not given me what I ordered for. So it means that that one is as an asset to me. Somebody is owing me. So prepaid expense is a current asset. Why am I doing all of this? I'm saying this so that the reason many people, when it appears as if many people are not able to answer certain questions in JAMB, is because you just crammed it. What some people know as reading is actually cramming. They'll just read something and try to cram it. If it stick, or if it does not stick. So if they don't see a question brought out in that same manner, they will not be able to answer it. That's the major issue. But if you understand what we are actually trying to say, or what that particular concept is all about, then you can apply it to any question that you see. You just have to calm down, practice a lot, so that when you get to the exam hall, it's already a part of you. So prepaid income is also the opposite of this one. Now we are saying that you are a hairdresser. Don't forget, you are still an hairdresser. You are supposed to plait hair for somebody and that person came and said, see, look at my hair oh, it's almost rough, but I don't have time to plait it today. I have the money but I don't have the time yet. Let me pay you. So the person pays you 15,000 naira and the person says, I'll come back next month when I should have leave next month. So when I get my leave from my place of work next month, I would come and do what? I will come and plait my hair. Once that person has given you the money but you have not rendered service, that's what? That's a liability to you. You are owing that person something. What will that something be? The person's money. Because the person can come tomorrow and say, I'm not doing my hair, let me take my money. That's a liability on you. Do you understand that? Because you are expecting to give somebody something. So prepaid income will then be a what? A current liability. Don't worry, I have placed some questions in our quiz sessions and that's what we are going to do. So those are the questions that we are going to solve. But I believe that this should be understandable because I've tried to break it down in a way that you guys will actually what? Will understand. You must understand the concept. It is that concept, it is your understanding of the concept that will make it easy for you. Now, if you don't want to get too confused, think about accruals and payment is like debtors and creditors. Somebody bought goods for you from you and they did not pay. That's an asset to you. You bought goods from somebody and you did not pay. That's a liability to you. That's the same way you enjoyed expense but you have not paid. That's accrued expense. It's a liability. You offered service, sorry, and the person have not paid. That's a liability. That's like creditor. The person is a creditor to you, so it's still like the same thing. It's just that when it comes to expense, we call it accruals. But when it comes to goods, we call it what? Debtors. Do you understand that? So the same thing for this. So the same way this happens is also the same way somebody can owe you, can buy goods from you and not pay on time or not pay immediately. It's also the same way somebody can pay you in advance. So prepayment, another name for prepayment is also advance payment or deferred payment or deferrals. Deferrals, sometimes they call it deferrals. So somebody has paid but he deferred the time that will come and collect his goods. So the same way somebody can just pay, give you money and pay in advance and say I'll come and pack my product next month. That's what? That will be a liability to you. And the same way you can also pay like a down payment to your creditors and tell them that you come and pack your goods next year. That will be an asset because they are the one owing. So that's just it. And I hope you guys understand. All right. So now let me talk about it one by one again. So I'm just putting this so that you guys can see a structured way for it in case you have not written anything. But of course, you have the video. It's something that you can just go back and you can just go back and watch the video again and again if you don't understand anything. All right. So accrued expense occurs when an expense is paid for after it has been incurred. So don't forget, money is moving after goods or services has moved. It is treated as a current liability in the balance sheet. You must know this. Accrued income, it occurs when income has been earned but cash has not been received. So services is moving before cash. So cash is paid after we have rendered the related service. It is treated as current asset. Prepaid as expense, current asset. Prepaid income, current liability. So I've explained it already. So now to the accounting treatment. What's the effect of all of this prepayment and all of that? Now note, accruals are always added to the relevant income or expense. What does that mean? It means that whenever you have accrued expenses, you are supposed to add it to the related expense. So if you have accrued rent, what do? You add it to the rent account. So it means you'll be debiting. This is the double entry that I'm writing out. We should come and continue it here. So for accrued expense, I've used this whiteboard. I'll just write out the double entries for me. So for accrued expense, you have to add it to rent account. So you say debit expense account and credit accrued expense account. Don't forget, accrued expense is a liability, and all liability has what? Credit balance. That's why we are crediting it. Accrued income. What do you do? It will be the opposite of this. Debit accrued income account, because that's the liability, and you credit the relevant income account, whether it's commission received or anything. So you see that we are adding it to what is already there, because if you debit expense, it means you're adding it to what is there. So the main, okay, let me just write it out to you, then I will explain it a little before we move on to the quiz. Okay, I still have one more whiteboard that I can use for the quiz. So if you have prepaid expense, number one, number two, number three. If you have prepaid expense, you say debit and credit. Now let me show you. Prepayments are deducted from the relevant income or expenditure. So you can say that you always what? You always deduct prepayment. So if you want to deduct prepayment from, for example, from expense, it means that you have to credit the expense account. So don't forget, prepaid expense is an asset, so you have to debit it. So you say prepaid, debit prepaid expense account and credit expense account. Number four, prepaid income account. So it's still like this, but because it's income, you have to debit income account because you are removing something from income. So you say debit income account and credit what? Don't forget, say we always remove it, so that's why you're debiting income account. And credit your prepaid income account because it's the liability account. Do you understand that? So this is what usually happens. Don't forget, I said this whole thing is based on the accrual concept. You know, accrual and matching concept are one concept, all right, because of the accrual and matching concept. There's also another concept, revenue recognition concept. Another name for revenue recognition is realization concept. For full explanation about this concept, you can watch my video on accounting concept and convention. All right, is that fine? So now this is the way it works. Revenue recognition or realization concept says that revenue should only be recognized when earned and not necessarily when cash is received. That is, you should recognize, when you say recognize revenue, that means put it in your financial statement once you earn it. So now the question was now, when do you earn, when are we going to say that okay, I have earned this income? He said when there is the transfer of goods and services or services. So that's why when we sell goods, even though if we sell goods on credit, even though they have not paid, we still treat it as what? As sales. Because revenue recognition tells us that once we have transferred goods and services, then we can decide that we have what? We have earned that revenue, so it has to be recognized. So the same thing for normal services too. All right. Once we have rendered the service, then we have earned it. I don't want you guys to get confused. So for income. But for expense, the accrual concept states that income should be recognized when earned and should be recorded when earned and not necessarily when cash is received. While expense should be recognized when incurred and not necessarily when cash is paid. So once we incur an expense, we are supposed to what? To recognize it. But in the same way, if you have not incurred an expense or earned an income, you are not supposed to recognize it, regardless of whether you have paid money or received money. So it means that, for example, if goods move before money, then we have earned or incurred, we have earned income or incurred expense. But if money move before goods move, until goods move, there is no earning of revenue or income or incurring expense. You cannot incur expense if there is no movement of goods. So if, for example, you paid me 1 million naira to do something for you, you cannot recognize that thing as being done or as done. You cannot recognize it as expense. You have not incurred an expense. You just gave somebody money. It's until I come, and then because you can wake up tomorrow morning and collect your money back because the person has not done it. But once the person does that thing, maybe you want to build your fence. Once the person builds the fence, you are already owing the person. So that one has been sorted. But if you give somebody money, say, "I come and build my fence next week," oh, then the person, but before next week, you collected your money back. That's not an expense now. You have collected your money. It's still possible for you to collect your money. But once service has moved, you cannot undo service. Do you understand why they said income is earned when goods move or when services move? When you have rendered the service, that's when we say you have earned income. You are already owing me. Bami, owe me. Bring my money. Give me my money. Do you understand that? So accrual concept and margin concept, that's what they say. So margin concept saying that income in a period should be matched against expense in that period. So there is something called so there is now, it means that you can have a mismatch where you'll be matching expense that is related to another period. You'll be matching it to this year. What does that mean? It means that, okay, put that in your left hand and don't use it to eat amala. Let me explain this. Why are we debiting expense account? It is because normally when accrued expense occur, it means that goods have moved, so we have incurred expense. So it has to enter into expense account. Just like if you pay for electricity. Just that when you pay for electricity, you say debit electricity account and credit cash. But now we have enjoyed electricity, but we did not use it. Do you get? We are sorry, we have enjoyed the electricity, but we did not pay for it. So it is a liability to us, so we create a liability account. So you say debit expense, just as the same way you say debit purchases and credit your creditor. Because you have collected goods, it's just that you have not paid. So it's the same thing. For accrued income too, you render services to somebody but they have not paid. So since you have rendered the services, it means that you have earned that income. It is the period where you earn that income that is what? When you render the service, that's when you earn the income. So that's why you must put it in income account for that year. Then you debit accrued income. Now when it comes to prepaid expense, you have to debit prepaid expense account and credit expense account. Why is that? It is because normally It's possible that once people see money like this, they will take it directly to expense account. For example, what I said earlier, if we pay the electricity, we just say debit electricity and credit cash. Alright. Now, at the end of the year, don't forget that what we are doing is end of the year adjustment, end of period adjustment, adjustment to final account. At the end of the year, we now notice that maybe it was 3,000 naira that we paid o, but we notice that this 3,000 naira, 500 naira out of it is for next year. It means that this 500,000 naira does not belong to this year. Why? We have not incurred that expense. We have not enjoyed the benefit. Because of that, it has to be removed. 3,000 naira is on the debit side. So you now come and put 500 naira on the debit side. It will now remain 2,500 naira, 2,500 that is for this year. So that's why we say you should credit expense account and debit prepaid expense account. So the same way for sorry. So the same way for prepaid income too. Alright. What has happened? Somebody paid us money, but we have not. So maybe somebody paid us something money this year, but we will not render the service until next year. We margin concept is saying that that income must not be recognized in this year, it should be taken to next year. Just as if you are going to incur expense next year, even though they pay this year, you cannot recognize it as an expense until next year. So you have to remove it from. So for prepaid, even though you have received money this year but you have not rendered the service, you have to wait till next year when you render the service before you add it to income. And when you receive money, you might have automatically added it to income, so you come back, you debit it to remove it. So that's the way it works. That's the explanation for that. All right. So with that, actually, we have come to the end. So we just solve some questions that I put in the quiz. While solving the question, you see the application of some of the things I've explained earlier too, and then of course you would also I'll also like use it to explain further, just in case I left anything out. Now, number one, question one: the fact that allowances are made against doubtful debt oppose the concept of dash. A. Prudency. B. Materiality. C. Business entity. D. Realization. The fact that allowances are made against doubtful debt oppose the concept of A. Prudency, materiality, C. Business entity, and D. Realization. This is what? Don't forget, provision allowance is the same thing as provision is the same thing as allowance, or allowance is the same thing as provision. So what they are just saying here is the fact that provisions are made against doubtful debt. The fact that you have something like provision for doubtful debt oppose the concept of what? The answer is prudency. Don't forget, prudency says that you should what? You should provide for future possible losses. Doubtful debt means that it is possible that these people will default in their payment and then they will not pay us. All right. So let us prepare for it. Do you understand that? So that's prudency concept. It means that you are being prudent, you are being proactive to recognize expense before they actually materialize. Question two: a customer owing $200,000 $200,000. Pay attention o. He owed 200,000. He was allowed to pay 180,000 in full settlement of his indebtedness. This results in what? You are owing me $200,000 cedis rather. I now say, oh yeah, don't even worry yourself. Pay 180. What does that result in? Number A, option A, decrease in liability, increase in asset, and increase in capital. Does that work? If the person is owing us 200,000 and he paid, there's no decrease in liability now. So that cannot even be there. Because if a customer is owing us 200,000, it means that we have asset of 200,000. So there's no decrease in liability. So, but before we even go to the option again, so notice that I'm supposed to pay 200,000. I paid 180,000, it basically means that there is a bad debt of 20,000 naira. Bad debt. And this bad debt will be taken to the debit side of profit or loss account, which means it will reduce our profit. And don't forget, net profit is always added to capital. So whenever you have expense, it means that your capital is reducing. So automatically, capital is reducing. So this one cannot even be correct. Do you understand that? Now, if customer is owing us 200,000, if he paid 180,000, what has happened? Our receivables of 200,000 naira has turned to zero because we collected 180,000 naira in cash and 20,000 naira, we call it bad debt. So receivables has reduced. But because we collected 180,000 naira cash, there is an increase in cash and there is a decrease in capital. So if you look at all these options, which one is the correct one? Which one satisfies everything that we analyzed? This one. If you say decrease in asset, there was no decrease in asset. There might be a little decrease in asset, right? But we paid. If we add asset of 200,000, which is debtor, once they pay 180,000, assets will reduce by 180,000. It also increased by cash. So of course you can say assets decrease by, but assets will only decrease by 20,000. But at the end of the day, the best answer is this one. Your receivables decreased to zero. Your cash will increase by 180,000, and then your capital also what? Also decreased. So for this question, once I even see anything like liability, I will remove it because there's nothing like liability. So for this one, it cannot be the answer. It cannot be the answer. It cannot be the answer. It cannot. Once I see liabilities like this, it cannot be there. Do we understand that? So the answer is C. Now, question 3. When provision for doubtful debt receivable, when provision for doubtful trade receivable, we are still talking about doubtful debt, is in the trial balance is no longer required, what is the accounting entry? So when it is no longer required, it means that we had 5,000 naira before. We now say, we don't want provision for doubtful debt again, Jare. That means it will reduce to zero. So that falls under what? Reduction in provision for doubtful debt. And when there's a reduction in provision for doubtful debt, what do we have? You have to debit, so it's an income. So you debit your provision and you credit your P or L. Do you understand that? So what would be the correct answer here? Option C. Your provision for doubtful debt does not affect your trade receivables account at all. Provision for doubtful debt does not, there's nothing that concerns provision for doubtful debt with trade receivables. You don't take it to the account at all. Do you understand that? So you can never put provision for doubtful debt inside trade receivables. You take it. So to remove it, you either do it in your workings or you go and remove it directly on the face of your balance sheet. You write trade receivable or debtor, then you say less provision for doubtful debt. So it does not affect. So it cannot be this. It cannot be this. It cannot be this. Provision for doubtful debt is not the same thing as bad debt, so it cannot be this. So the option is C or D. But now that we know that since it's an income, since it's a reduction in provision for doubtful debt, then it is an income. You have to credit POL and debit provision for doubtful debt. So the correct answer is C. Now let's move on to the next question. That's question 4. Question 4. Annual rent payable. So this one is on accruals on payment. Annual rent payable is 500,000 naira. What does that mean? It means that for the year we are supposed to pay 500,000 naira as rent. Rent prepaid at 1st January 2016. But at the beginning of the year, we noticed that there was rent prepaid, which means from last year we had paid 80,000 naira. From last year. So if the total amount that we are supposed to pay is 500,000 and we have paid 80,000 naira, then it has reduced. But let me just do this. Let's do it in double entry form. Annual rent payable is $500,000. So let's have something like this. We have rent account. All right. So rent prepaid at 1st January 2016 was 80,000 naira and rent accrued at 31st December 2016 was 60,000 naira. How much was paid in respect of rent in 2016? We can do it in this one, but we can also do it in mathematics. Let's do mathematics first, then I'll do the accounting. Because when you get to the exam, you can just use the mathematics and just do it on time. Do you understand that? So you have rent prepaid. You are supposed to pay rent of 500,000 naira, but you pay 80,000 naira out of it since last year. So you already paid 80,000 naira since last year. How much is your debt remaining? 420,000. Now they now said rent accrued at 31st December 2016. What does rent accrued means? It means rent owing. You were now owing at the end of the year, you now owed 60,000 naira. If you owe 60,000 naira, it means that you must have paid. I've paid 80,000 naira, so my total owing should be 420,000. So if at the end of the year I owe 60,000, it means that I have paid 420 minus 60. For me to owe 60,000, it means that I paid 360,000. Do you understand that? So um with the plus and minus things that we did. So if you want to do this in double entry, rent account, this is rent prepaid. Since it's an asset, it will come to the debit side. It's an opening balance. So it's come here, you say balance brought forward, prepayment. That's 80,000 naira. All right. 31st December 2016, rent accrued. Rent accrued is a liability. So it will have a credit balance. And don't forget, credit balance means that your credit side is greater than your debit side. If your credit side is greater than your debit side, then the balance carried down will be here. So you come here, you say balance carried down, accrued. How much? 60,000. Now the amount that you paid is supposed to be here. That's what we don't know. That's our balancing figure. All right. But the amount of 500,000 that we have here, this is the amount that is incurred because that's annual rent that we are supposed to pay in 500,000. So in 2016, so if we use that building in 2016, it means that the amount that is supposed to go to POL is 500,000 naira. That's the total amount incurred on rent. So you will come here. So don't forget everything that we explained though. It is only the amount that you incur that is going to rent. So your annual rent payable is the amount that you incur for the year. So that's the amount going to POL. So you have to come here. POL, how much? 500,000. So and then you say so 500,000 minus 80,000 minus 60,000. 80 plus 60 is 140. 500 minus, so that's 140,000. So what did I write to? I'm sorry, that's 360,000. So your answer is C. So please don't forget, I did not forget that I mentioned that accruals are to be added except it's at the beginning. Prepayment are to be deducted except it's at the beginning. It's just that this question they twisted it, which means when I was talking about accruals are to be added, prepayment are to be deducted, we are talking about when they give you the cash figure. Now this, so you want to get this, they gave you the cash figure. Look at it oh. If you add accruals, you have 360 plus 60. That's 420. You are supposed to deduct prepayment, but prepayment happens at the beginning. So you do the opposite. Don't forget what I wrote here. I said accruals are added to the relevant income or expense while prepayments are deducted from the relevant income or expenditure. Then the treatment for accruals and prepayments carried forward from the previous year will be the opposite. So normally we are supposed to add accruals, but if it is coming from last year, we deduct it. But we are talking about when we have the cash. Normally we are supposed to deduct prepayment, but if it's coming from last year, we what? We add. So for this one, let's assume that we already have the cash and they told us to find 500,000. If you have 360,000, they said total amount paid was 360,000. All right. The question was now that how much we go to PON. This is the way you calculate it. You say 360 plus the accruals. Accrual is happening at the end, so add it. That's 60. That gives you for 20,000. Now, for normal prepayment, you are supposed to deduct it, but because it's at the beginning, that means it is carried forward from the previous year, from last year. You have to what? Instead of deducting it now, you have to do the opposite, which is to add it plus 80. That will now give you 500,000 naira. Do you understand that? So, it's still the same thing. I'm not going back on my word. I don't want you guys to get confused. That's why I have to clarify that. Now, question 5, quickly, because of time. Now, it said which of the following would result from an increase in the allowance for bad debt? Now, when I increase allowance for bad debt, that is what? An expense. And I would have to debit PON. Now, don't forget, when I debit PON, so because I'm debiting PON, it means that there's nothing that concerns us with gross profit and assets. Do you understand that? We don't, okay, there's nothing that concerns us with gross profit and gross profit, only net profit and asset. Because if you have allowance for doubtful debt, you have to go and deduct your allowance for doubtful debt from assets, from your debtor, so you can affect assets. But since it is increasing, assets cannot increase too. Assets will rather reduce. So E cannot be the answer, A cannot be the answer, B cannot be the answer. The answer is between C and D. So the question is, when there's increment in allowance for doubtful debt, is it an expense or an income? It is an expense. Will an expense decrease net profit or increase net profit? It will decrease net profit. So your answer is still C. Question 6. During the year 2016, Vincent paid rent amounting to 500,000. Now, okay, so now look at this. We'll see the addition and subtraction points that I said. So write 500,000 naira on your calculator. This is my own calculator. So Vincent paid rent amounting to 500,000. He owed 50,000 at the beginning of the year. Don't forget, I said owed, that's accruals, abi. So we are supposed to add it. But he said it was at the beginning of the year, which means it must be something that he brought from last year. Do you understand that? So instead of adding it, we will now deduct it. So we say minus 50,000. All right. Then I said, and by 31st December 2016, he had paid rent in advance of 100,000 naira. Do you add prepayment or you less it? You less it. Is at the end, so you less it. It's not the opposite. So you say minus 100,000. So the answer is his rent charge for 2016 was what? 350,000 from my calculator. That's option A. So do you understand that? So if I want to do it using double entry, I'll say something like rent account. All right. Opening balance is 50,000, but opening balance is an owing, so that's the liability. So it will come to credit side. So you say balance brought forward. Owing, that's how much? 50,000 naira. But we paid rent of 500,000. That will become here because you say debit rent account and credit cash. So you say cash. How much? 500,000. So this looks like 800. So 31st December 2016, we had prepaid rent of 100,000. Prepaid rent, is it an asset or a liability? Asset, which means that your debit side will be greater than your credit side. So the balance carried down will be here. Prepaid 100,000. So we now say total is 500,000. The amount going to P or L is now what? 350,000. So if you want me to explain that in another way, it basically means that this 350,000 is his rent charge. That's the amount going to P or L. That's the amount he incurred in the year. So, so you can just look it. You can look at it in this way that okay, this guy paid 500,000 this year, but if he owed 50,000 naira from last year, okay, if I owe you 50,000 naira from last year and I give you this year and I give you 500,000, which money are you going to first remove? You first remove the one from last year now, abi? So 500,000 minus 50,000. So that's the one you first remove. All right. E now remain 450,000 with you. Then you use the remaining 450,000 to do for this year. But after you now remove the money for this year, you now saw that it still remained 100,000 that is for next year. So if you have 450,000, I have 450,000 naira with you, and at the end of the year you still notice that you now said there's 100,000 naira that is for next year. It means that 450 minus 100,000, which is 350,000 naira, is the money for this year. Do you understand that? So let's go to question 7 quickly. That's our last one. So question 7, given general expenses account, paid by check 671, paid by cash 70. So our total payment is 671 plus 670. 671 plus 70. Whether they paid it by cash or by check, it just means that they have paid it. So our total cash is what? Total payment is 741. Now, accrued brought forward from last year. Don't forget, you are supposed to add accruals, but when it's coming from last year, you deduct. So you say minus 65. Then accrued carried forward is what is added plus 115. So what will be our answer? 791. So the answer is C. If you want to do it in ledger, you have something like this: debit, general expenses account, all right. So the balance brought forward is a liability. So you come here and say balance brought forward. Since accrued expense 65, accrued carried forward will be here. You say balance carried down 115. Then the amount that was paid, you debit bank, you debit expense and credit cash. So you come here and say bank 671, cash 70. So by the time you have this, you have 671 plus 70 plus 115. So this is total of 856. 856 minus 65. That's 791. That's the amount going to P or N. So that's why it's 791. All right, so this is this and that is that. So that is that about that. Thank you so much for listening. And I'll see you in the next lecture. And of course, see you at the top. Bye.